Namaskar. Today's topic, the meaning, scope and aims of a fiscal policy. This is a part of business environment policy. We need to understand what is exactly the fiscal policy. The fiscal policy refers to government policy in respect of public expenditure, taxation and public debt. It is a very important activity of the government. It means which the government adjusts its spending levels and tax rates to minor and influencing national economy. So it has to be monitor the influence in nation's economy. The fiscal policy is based on the principles of Keynesian economics, which basically states that government can influence microeconomics productivity levels by increasing or decreasing tax levels and public spendings. So we are under mixed economy system. After independence, the government of India is decided to continue the mixed economy system. In this, the government is collecting the funds through the taxation system and it will be implementing for the poor people, so that the objective of the government to level the economy of the people. So that is the reason the fiscal policy is one of the very important policy to the government, which it can be organized the government properly with the public intentions. Here fiscal policy is a tool used for the government to influence the economy through the taxation and spendings, and the main objective of the fiscal policy in India are some important bases. The first is to promote the economy, economic growth. The fiscal policy aims to maintain the increasing the growth of a rate of economy every time and every year, and stabilizing the price levels. Fiscal policy aims to control inflation and stabilization of price levels. The second point which we are basing on the fiscal policy. And to reduce inequality, fiscal policy aims to reduce income and wealth equality by providing the incentives to the private sector. Rise living standards. The fiscal policy aims to improve the standards of living of citizens. Balance the balance of payment. The fiscal policy aims to maintain equilibrium to the balance of payment. So these are all some of important steps. Let us move on to the objective of fiscal policy in India. Some of the main objective of fiscal policy in India can be scanned as follows. We can understand based on these objectives. To mobilize the additional resources into socially necessary lines of development. We need to identify what are the important social necessities, as basically we know food, shelter, a remaining requirement for minimum living. So for that the government has to be maintained this fiscal policy on the basis of first objective. To achieve and maintain economic stability. So the government is maintain the economic stability is very important. Sometimes going high, sometimes coming down. The lapses of economy is very dangerous for the human life. That's the reason the government's second objective for the fiscal policy is to achieve maintain the economic stability. To stabilize the price levels, we have to be controlled the price levels. We have to be organized. We have to regularize the products, purchases, sales, cost, everything under the system of fiscal policy. That's the reason the objective, another objective is based on stabilizing the price levels. Next item, to maintain the growth rate of economy. So every time the people are expecting to make the growth towards left to right. When you are making the graph x axis, y axis, the graph should grow up every time. That's the reason. So this is important objective for the fiscal policy. To maintain equilibrium in the balance of payment. Government is having some liabilities. Government is having some deposits. Government is having the stores of gold, cash and some valuable items, which we are balancing the liabilities and lendings from the other places. That is the reason the fiscal policy helpful to maintain the balancing system. Next item, to raise the standards of living of citizen of country. So every country is looking for the standard living of the human beings, the citizens of that particular country. We need to be provide the facilities. We need to be provide standard of living and other things based on this fiscal policy. And next item, to reduce extreme inequality in income and wealth. Some people are very rich people, some people are very poor people. Discrimination should be reduced and everybody should come into the one particular level which we are collecting the taxes from rich people utilizing for the poor people. So, this can be reducing the extreme inequality in income and wealth. The last item, to provide the necessary incentives to the private sector for its healthy growth, etc. Even not only government, sometimes private sector also very important for the development of economy. So, we should be given some incentives and some improvements to get private sector come into the focus of public and public expenditures. The tools of fiscal policy, the major tools of fiscal policy used by the government are as follows. We have some of the important public expenditure, important items. Under that, public expenditure is one and taxation is second. Let us think about public expenditure. What could be the public expenditure? We have microeconomics and macroeconomics. The macroeconomics talk about public expenditure. It includes subsidies, transfer of payments, including welfare programs, public works, projects, government salaries. By decreasing of spendings, the government can directly influence the economy activities. For example, more government spendings can increase the demand, leading to higher output of the employment. Now, that is the reason government wants to manage sometimes the public expenditure system so that the demand can be created, sometimes demand can be reduced. This is the first tool of the fiscal policy. The second tool is a taxation. The government can influence economic activities through its taxation policy. By reducing taxes, the government leaves individuals and business with more income to spend and invest, which can boost the economic growth. Conversely, increasing taxes can help cool down an overheated economy by reducing the amount of disposable income available. So, that is the reason the tools of fiscal policy should be helpful for the government for the making the systematic policy. And we have third category, public borrowings. Public borrowings refers to the means by which the government finance their expenditure that exceeds the tax revenue. Under it, the government raises many forms the domestic population or farm abroad through instruments such as bonds, NSC, National Savings Certificates, Kishan Vikas Patra, etc. Public borrowings is the common practices used to fund the public service, infrastructure projects, welfare programs, and to manage the country's fiscal policy. The another item, the other measures, other physical measurements adopted by the government includes rotating and price controlling and regulation of wages, increase the production of goods and services. We have some differences between fiscal policy and monetary policy. If you think fiscal policy is completely taxation, this can be taken up by the government of India under the finance ministry. The policy can be prepared and it can be implemented for the next financial year. Monetary policy is completely depending on the banking system. Generally, this type of monetary policy will be implemented by the Reserve Bank of India governor and its team. Let us come to the one by one point. The definition, it is macroeconomics, which one? Fiscal policy used by the government to adjust its spending levels and tax rates to monitor and nation's economy. That is the definition of the fiscal policy. Let us come to the monetary policy. It is a macro, not MICOR, macro, MACRO, macroeconomic policy used by the central bank to influence the money supply and interest rates. What is central bank? The central bank, which is the responsibility given by Reserve Bank of India to manage their activities, whatever the Reserve Bank of India is doing, that all activities is given responsibility to the main branch of that local area. Just like a State Bank of India is managing all receipts and payments and regulatory commissions, everything through their branches. So, that is, we can say, it is central bank activity. The central bank will be influencing the money, supply, interest, etc. That is the definition of monetary policy. Institutional control, controlled by the government. So directly, as I said, it is controlled by Finance Ministry, Government of India. Their policy, it will be implemented in the fiscal policy. Whereas monetary policy controlled by central banking system, that is Reserve Bank of India, its responsible branches. It's controlled big banks that they will be controlling the monetary policy. Prime objective, if you take into the fiscal policy, to influence the economic conditions. If you take into the monetary policy, it influences the money supply and interest rates, etc. If you come into the major tools, public expenditure, public borrowing is the tool of fiscal policy. Bank rates, cash reserve ratio, statutory liquidity ratio, etc. is maintained by the monetary policy. Then if you look into the chart, in this we have two major categories which we have already explained. Is a flow chart which you can understand. The government policies are two categories. One is fiscal policy, another one is monetary policy. Under fiscal policy, we have taxation and government spendings, two categories. Under monetary policy, we have two important one is called interest rates and money supply. So money receipts and payments and all these things we can see into the monetary policy. Let's come to the types of fiscal policies. Under the types of fiscal policies, we have mechanism, objectives, and we have caution and suitability. So these options we can see into the main intention of expansionary, contractionary, neutral. Three categories we can identify what are the fiscal policy issues, which we are already discussed. It's a small item which we can read easily. Then, because of time limit, we need to understand what is important cyclicality of the fiscal policy. If you make a rotation of one particular item in one particular period, so this how policy will be implemented, we can understand under this particular topic. The cyclicality of the fiscal policy refers to change the directions of government expenditure and taxes based on economic conditions and inflation, incorporation and in economic growth. Everything will be look into this particular item. There are two types of cyclical fiscal policy. The first one is counter cyclical fiscal policy. It refers to the steps taken by the government that go against the directions of the economy or business cycle. This is the first point. How it can be easily understand. For example, in recession time, the shutdown of some institutions and the government is going very slowly. Usually it takes the routes of expansionary fiscal policy. This increases expenditure and it reduces taxes to create the demand that can drive the economy booming. So this increases the consumption potentials of economic and helps the recession of the particular period. And we have pro-cyclical fiscal policy. It refers to the types of fiscal policy wherein the government reinforce the business cycle by being the expansionary during good times and also contractionary during the recession period. Pursuing a pro-cyclical fiscal policy is generally records to damage its raise microeconomy volatility, depress investment, hamper growth, and then it is for harm to the poor people. For example, adoption contractionary fiscal policy during the recession period will reduce the government expenditure and it increase the taxes. This will further decrease the consumption potentials of economy and deepen on the recessions. Related to the concept fiscal policy, we have some more expansions in this particular policy definition. Not only definition, it will be given the expansion of the fiscal policy. Fiscal deficit refers to the gap between the government total expenditure in the given financial year and its total revenue. So that differences is given by fiscal deficit. It includes borrowings in the same financial year. It is expressed as the percentage of the gross domestic production, it is called GDP, and it's an indicator of the government of financial health. Sorry. Physical consolidation. Physical consolidation is the process where the government physical health is improved by the reducing physical deficit to level which the manageable and bearable for the economy. Improved tax revenue realization and better expenditures are improving components of physical conditions. So, we have many other relative concepts which are taking into the physical dragness, physical naturality and crowding out the effects. These are all we can just read out, which is not important, but we need to understand what is economic assimilation, pump priming, and we can see other important items. Let us go into the recent physical reforms. This is also one of the main important point in the syllabus. Physical deficit, which we have already discussed in the previous slide, the government has raised the physical deficit targeting to 5.8% for the 2023-24 year. The goal is to reduce the physical deficit to less than 4.5% of GDP by 2025-26. This is the aim of government from next year to this year, how the government is reducing the physical deficit. Off budget borrowings, the government has stopped off budget borrowing since 2021-22, which harms to the government budget. That is the reason it was stopped. The capital expenditure, the government has increased capital expenditure especially in infrastructure, intensive sector like roads, railways and housing, other items. If you look into the service tax, the number of service items was included in the recent taxation system, which is there in GST. The number of services subjected to the service tax has increased gradually from 3 in 1994-95 to 100 in 2007-8. Now, if you look into the 2024, we have merged into GST and number of services are identified in the service tax. This is one of the emerging taxation system in the fiscal policy. Corporate income tax. The government has implemented extensive corporate income tax reforms. Earlier, it is a part of taxation of companies 30%, 35% and 45%. Now, it comes to reducing 25% because of the government policy. Then look into the subsidies. The government has reduced the subsidies relatively to the GDP. Direct benefit transfers. The government has implemented scheme like direct benefit transfer scheme. This is DBT. Many state government also is adopted. The finance minister is responsible for the formulating fiscal policy in India. Let us come to the taxation system in India. We have two important tax types, direct taxation and indirect taxation. Before going into that, what are the important introduction? India has a well developed tax structure with a clearly democratic authority between central and state governments and local bodies. Central government levies taxes on income except tax on agricultural income, which the state government can impose the same thing, levy. The customs duty, central excise and service tax, now it is called GST, is implemented by the government of India. Value added tax VAT, stamp duty, state excise, land revenue and tax on profession and levied by the state government, now it is merged into GST. Local bodies are empowered to levy tax on properties, octroi and for utilities like water supply, drainage, etc. This is local bodies is maintaining same till now. In the last 10 to 15 years, Indian taxation system has undergone the tremendous reforms. The tax rates have been rationalized and the tax laws have been simplified, resulting in better compliance, easy of tax payments and better comfortments, and goods and service tax gains shall be implemented. It was already implemented. and how it is getting all this income, we can see in the recent trends. The tax levied by the central government, we have direct taxes and indirect taxes. So direct taxes, tax on corporate income, capital gain tax, personal income tax, tax incentives, double taxation avoidance treaty, these are all comes under direct taxes. Earlier we have gift tax, and we have this gift tax is merged into income tax, and we have wealth tax also. So that also now we are planning to make into the direct taxes, the government wanted to include. Then let's come to the indirect taxes. We have central excise, customs duty, service tax, and STT, security transaction tax. Because of GST, the service tax is converted as GST, but still excise duty, custom duty is continuing, and STT also is continuing. Taxes levied by state government and local bodies. As we have already discussed, sales tax is converted into GST. Sales tax and VAT is combinedly organizing by central government and state government because of new NDA government. And we have other taxes also. The pattern of expenditure, the union budget in the India classified in the total public expenditure into two components: revenue expenditure, capital expenditure. The former is committed expenditure and also less productivity expenditure categorized such as pensions, salaries, subsidies, interest, payments, etc. comes under revenue expenditure. Union budget, this is the last topic. Union budget 2023-24 analysis is very important because the student has to understand what recently happened, the changes in the government. If you look into the fiscal policy, as we have already discussed, the receipts and payments of government, the expenditure, the government proposed to spend rupees 45 lakhs 3097 crores rupees in 2023-24, which is an increase of 7.5% over the raised estimation of 2022-23. In 22-23, total expenditure is estimated to 6.1% higher than the budget estimations. This is one important identification. Let's come to receipts. The receipts other than the borrowings in 2023-24 are expected to be 27 lakhs 16,281 crores, an increase of 11.7% over revised estimation of 22-23. In 22-23, total receipts other than the borrowings are estimated to be 6.5% higher than the budget estimations. The GDP, the government has estimated a nominal GDP growth rate of 10.5% to 2023-24, that is real growth plus inflation. And we have so many other identifications. But all these things, only deficit can be completed, because revenue deficit is 23-24 is targeted 2.9% of GDP, which is lower than the revised estimation of 4.1%. That is a big development which we can identify. Fiscal deficit in 23-24 is targeted to 5.9% of GDP, lower than the revised estimation of 6.4%. This is very important thing, how the government is running with the public policies, fiscal policies. We can look into the economy position and other things, and other points easily we can understand: ministry allocation and expenditures, and union budget, other points also we can easily understand. But the expenditure and receipts deficit equal to the GDP is very important, which we can estimate how the government is increasing and decreasing. These are all remaining policy highlights, and this is the figures which we can compare with the 22, 23, 24 estimations. So these are all the figures you can check into the item wise, and we can identify the growth of Indian economy based on fiscal policy. Thank you one and all.